Traditional IRAs, Penalty for Excess Contributions, Part 5. An excess contribution to a traditional IRA may be subject to a penalty tax of 6%. This penalty is applicable on both deductible and non-deductible contributions. If you filed your 2013 tax return by the due date, with extensions, the IRS allows the excess contribution withdrawal to be made no later than October 15, 2014. The related earnings must be reported on an amended return that explains the withdrawal. You can avoid the 6% penalty by withdrawing the excess contribution by the due date for your return, including extensions, plus any income earned on the contribution. Earnings from the excess contributions must be withdrawn and reported as income on your return for the year the excess contributions were made. The earnings should be reported to you as a taxable distribution on Form 1099-R. If you make an excess contribution and do not correct the excess, you will be subject to another penalty on the excess contribution the following year and every year after that until it is corrected. If you do not make your excess contribution withdrawal, the 6% penalty will apply to your 2013 return. If you withdraw the excess from the 2013 contribution by December 31, 2014, you can avoid the 6% penalty for 2014. The other option is to reduce your allowable 2014 IRA contribution by the 2013 excess. Let's look at an excess contribution scenario. Angie contributes $7,500 to her traditional IRA and later discovers that she contributed $2,000 too much. She withdrew the $2,000 and $150 in income that was earned on the $2,000 before she filed her taxes. What will Angie need to report to the IRS? Since Angie made her excess contribution withdrawal prior to her tax filing date, she will not have to pay the 6% penalty for excess contributions. However, her earnings from excess contributions must be reported as income on a return for the year the excess contributions were made. The earnings should be reported to her as a taxable distribution on Form 1099-R. Traditional IRAs, Taxable Distributions, Part 6. If only deductible contributions were made to your traditional IRA, or IRAs if you have more than one, you have no basis in your IRA. Because you have no basis in your IRA, any distributions are fully taxable when received. Any distribution of deductible contributions from a traditional IRA will be taxed unless you roll it over or redeposit it within 60 days, which we'll discuss later. When you take distributions from your traditional IRA containing your non-deductible contributions, you split your withdrawal proportionately between the non-deductible contributions, your basis, and the rest of the account. The contribution portion is not taxable. However, withdrawn earnings from the contributions are taxable. The non-deductible contribution portion comes out tax-free. And even if taking a distribution before age 59.5, penalty-free, because the penalty only applies to the taxable portion. For example, if 30% of your traditional IRA value is non-deductible contributions, 30% is tax-free. To calculate tax-free basis amounts and taxable amounts, you create a fraction. The numerator equals your cumulative non-deductible contributions as of the end of the year. The denominator equals your IRA balance on that date plus all withdrawals taken during the year. Then multiply withdrawals by the fraction. The result is the amount of tax-free withdrawals of basis. The rest of your withdrawals are taxable. Let's look at a scenario regarding non-deductible contributions and a distribution. As of December 31st, 2013, you had made $12,000 in non-deductible contributions to your one traditional IRA. During 2013, you withdrew $20,000. On December 31st, 2013, the account was worth $60,000. Your fraction is 0.15, $12,000 divided by $60,000 plus $20,000. Now multiply your withdrawals by the fraction. The result is $3,000, or $20,000 times 0.15. The $3,000 is the amount of tax-free basis included in your withdrawals. The remaining $17,000, $20,000 minus $17,000, is taxable in 2013. Another type of taxable distribution are required minimum distributions. You must start to receive annual required minimum distributions, RMDs, from your traditional IRA after you reach age 70 and a half. Failure to take your RMD could result in penalties. Also, once you reach age 70 and a half, you can no longer contribute to a traditional IRA. However, you can contribute to a Roth IRA no matter what your age, as long as you have earned income that does not exceed the limit. If you borrow from your traditional IRA account or use it as security for a loan, your IRA account loses its tax-exempt status. If you use the account or part of it as security for a loan, the portion that is pledged is treated as a distribution. Borrowing from your traditional IRA will subject the account or the fair market value of the contract to tax at ordinary income rates as of the first day of the taxable year of the borrowing. However, a short-term loan may be made by withdrawing IRA funds and redepositing them in an IRA within 60 days, subject to the once-a-year rollover rule. A qualified charitable distribution is a tax-free transfer from a traditional IRA to an eligible charity by an IRA owner who is at least 70 and a half. The annual limit is $100,000. The qualified charitable distribution transfer must have been made in 2013 by your IRA trustee to a qualifying charity that is eligible to receive tax-deductible donations. If you file jointly with your spouse and she was at least 70 and a half, you can each claim up to the $100,000 exclusion with a qualified donation. If you made a qualified charitable distribution that includes any non-deductible contributions to your traditional IRA, the QCD is partly allocable to both the non-deductible and deductible contributions plus earnings. The transfer to charity must first come out of the deductible contributions plus earnings, the taxable portion. This is the excludable amount up to the $100,000 limit. The non-deductible portion of the qualified charitable distribution transfer is non-taxable. File Form 8606 to report the distribution of non-deductible contributions. The allocable amount reduces your remaining basis in your IRAs. Traditional IRAs. Penalty for withdrawals before age 59 and a half. Part 7. If you take a distribution from a traditional IRA before you are age 59 and a half, you have to pay a 10% penalty unless you qualify for an exception or if you complete a tax-free rollover within 60 days. The distribution amount will be exempted from the early withdrawal penalty if you meet one of the following exceptions. You plan to use the distribution towards the purchase or rebuilding of a first home for yourself or a qualified family member. This is limited to a $10,000 per lifetime exception. You become disabled before the distribution occurs. Your beneficiary receives the assets after your death. If you use the assets for medical expenses for which you are not reimbursed. If you use the assets for higher education expenses. If you use the assets to pay for medical insurance after you lose your job. If the assets are distributed as a result of an IRS levy, or if the amount distributed is a return of non-deductible contributions. Let's do a scenario calculating a penalty related to withdrawals before age 59 and a half. Henry is 55 years old and he decides to withdraw $5,000 from his traditional IRA to buy a boat. He has made a series of deductible contributions to his IRA over the past 20 years. What are his taxable consequences, if any? Because Henry deducted his contributions to his traditional IRA, he must include the $5,000 distribution as part of his taxable income and pay a premature distribution penalty tax of $500, 10% of the $5,000. Note that the 10% penalty only applies to a taxable portion of a distribution. The 10% penalty would not apply to any part of a distribution that may be tax-free because it is allocable to non-deductible contributions or rolled over to another IRA. If you become disabled before you reach age 59 and a half, any distributions from your traditional IRA because of your disability are not subject to the 10% additional tax. You must furnish proof that you have a physical or mental condition that prohibits you from doing any substantial gainful activity. Proof of your disability must be provided by a physician. A physician must determine that your condition can be expected to result in death or to be long, continued, and of indefinite duration. Another exception to the penalty for withdrawals before the age of 59 and a half is the medical expense exception. A distribution from a traditional IRA prior to the age of 59 and a half that is used to pay for substantial medical costs may avoid the 10% premature distribution tax. You do not have to itemize your deductions to take advantage of this exception to the 10% additional tax. More specifically, you do not have to pay the 10% additional tax on distributions that are not more than the amount you paid for unreimbursed medical expenses during the year of the distribution, minus 10% of your AGI for the year of the distribution, or 7.5% if you or your spouse was born before January 2nd, 1949. If you are under 59 and a half, unemployed, and received unemployment benefits under federal or state law for at least 12 consecutive weeks, you may make penalty-free IRA withdrawals to the extent of medical insurance premiums paid during the year for you, your spouse, and your dependents. With regards to the medical expense exception, you will not have to pay the 10% additional tax if all of the following conditions apply. If you lost your job, if you received unemployment compensation paid under any federal or state law for 12 consecutive weeks because you lost your job, if you received the distributions during either the year you received the unemployment compensation or the following year, if you receive the distributions no later than 60 days after you have been reemployed. Higher education expenses may also be another exception from the penalty for withdrawals before 59 and a half. If you're under age 59 and a half and you paid expenses for higher education during the year, part or all of any distribution may not be subject to the 10% additional tax. The penalty exception applies only if the withdrawal from the IRA and the payment of the qualified higher education expenses occur within the same year. When determining the amount of the distribution that is not subject to the 10% additional tax, you include qualified higher education expenses paid with any of the following: payment for services such as wages, a loan, a gift, an inheritance given to either the student or the individual making the withdrawal, or a withdrawal from personal savings. However, it is important that you do not include expenses paid with any of the following funds: tax-free distributions from a Coverdell Education Savings Account, tax-free part of scholarships and fellowships, from Pell Grants, from employer-provided educational assistance, from Veterans Educational Assistance, and from any other tax-free payment received as educational assistance, other than a gift or inheritance. Eligible expenses include tuition, fees, books, supplies, and equipment that are required for enrollment or attendance, plus room and board for a person who is at least a half-time student. The education must be for you, your spouse, or the children or grandchildren of you or your spouse. For a first-time homebuyer, an exception to the 10% penalty is allowed for up to $10,000 of qualifying first-time homebuyer expenses. This includes distributions you receive to buy, build, or rebuild a first home. A first-time homebuyer is generally someone who has no present interest in a main home during the 2-year period ending on the date of acquisition of the home which the distribution is being used to buy, build, or rebuild. If you are married, your spouse must also meet this no ownership agreement. If both you and your spouse are first-time homebuyers, each of you can receive distributions up to $10,000 for a first home without having to pay the 10% additional tax. To qualify for treatment as a first-time homebuyer, the distribution must meet all of the following requirements. It must be used to pay qualified acquisition costs before the close of the 120th day after the day you received it. When added to all your prior qualified first-time homebuyer distributions, if any, total qualifying distributions cannot be more than $10,000. Also, the distribution must be used to pay qualified costs for the main home of the first-time homebuyer who is any of the following: yourself, your spouse, your or your spouse's child, your or your spouse's grandchild, your or your spouse's parent or other ancestor. The date of acquisition is the date that you enter into a binding contract to buy the main home for which the distribution is being used, or the building or rebuilding of the main home for which the distribution is being used begins. If the requirements of the first-time homebuyer exception cannot be met because the planned purchase or construction of the home falls through, the law allows the taxpayer to return the distribution to the IRS within 120 days. The extension of the tax-free rollover period from 60 days to 120 days is automatic if the requirements are met. Another exception is for qualified reservist distributions. A member of the reserves called to active military duty for over 179 days or indefinitely is not subject to early distribution penalties for distributions received during the active duty period. Qualified reservist distributions may be recontributed to the plan within 2 years after the end of their active duty period, without regard to the regular limits on IRA contributions. A recontribution is not deductible. The term reserve component means the Army National Guard of the United States, the Army Reserve, the Naval Reserve, the Marine Corps Reserve. Reserve component also means the Air National Guard of the United States, Air Force Reserve, Coast Guard Reserve, or the Reserve Corps of the Public Health Service. Let's look at another early withdrawal scenario. Eddie's car breaks down and he needs $1,800 for repairs. The car is his only transportation and he needs it to get to work. Eddie has made deductible contributions to his one traditional IRA over many years. If Eddie, age 45, withdraws the money from his traditional IRA to pay for the repairs, will this emergency use of the funds qualify for an exception from the 10% premature withdrawal penalty? Unfortunately, emergency use of funds from a traditional IRA is not considered one of the exemptions from the early withdrawal penalty. Exemptions include disability, medical expenses, higher education, first-time home purchases, and qualified reservist distributions. Eddie can return the funds to a qualified traditional IRA within 60 days and avoid paying the 10% early withdrawal penalty.